Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about insurance and Melvin Moody. We all need insurance for certain valuable assets like our cars and our houses. We can also insure our stocks with something called a protective put. Insuring our stocks makes sense in certain scenarios, so I want to talk through that today because protection is important. Remember Rudy Garner from Meatballs, if you're old enough to remember that movie? He had to leave and he had to go to a whole different school and became Clifford. And that's where he met Melvin Moody. Melvin Moody started picking on him, so he needed protection. So he went out and he got this guy, right? That protected him for a while. But Melvin Moody wasn't done. Nope. He left and he grew up and he got fake teeth. Look at him. And then he started picking on my girlfriend, Mary, who's got goofy hair, but otherwise, pretty nice girl overall. So we all need protection from the Melvin Moody's of the world. For me, in 2022, it's been Facebook or Meta, right? So if I could go back to like January of this year and buy some protection against my Melvin Moody, Meta, I'd be much better off. I'd be really happy right now because I wouldn't have that huge loss in Facebook. So that's what I want to talk about today because there are definitely times when you want to have insurance on your stocks. So it's not complicated. You don't have to know a bunch of option Greeks, just a couple variables and some simple math. And that's how we'll present it today as we talk through this. So if that is what you're looking for, please stick around. Whoop. So there are a few different ways to protect our portfolio. One is with a simple stop loss. So if the stock falls below a certain price, it triggers the event, sells it, and you're in the clear, right? But that might not be the scenario that you really want to follow because it might cause a taxable gain that you weren't expecting. It might rebound right away, right? So there's different reasons that stop losses might not be right for your portfolio, but always keep those in your back pocket as well. Another one is just through diversification. Right now, if you had a bunch of oil stocks, you'd be doing really well in those. If you had some tech stocks as well, you'd be doing poor in those. So overall, just diversification can really help you out to protect your portfolio. Always be diverse. And the third one that really pops to mind is buying good, solid dividend paying stocks. So when the stock falls and you have drip turned on, for example, you'll buy more shares at a lower price. And over time, that should work out just like classic dollar cost averaging. So there's lots of different ways to add protection. You probably already have some of these in your portfolio. But for the protective put, this is one that's very deliberate. And we're going to say, okay, in this scenario, it makes sense for me to add a protective put. And it's not that complicated, like I mentioned. So we're going to work through some examples. I'm going to show you one that I actually have in my portfolio right now that I think was a smart decision. So one good example of a protective put that you might consider right now would be in the energy sector. So let's look at Chevron, for example. I think this is a pretty good example because if you bought this, if you were wise enough to purchase this back at the beginning of October of last year, just over a few months, you would have seen it would go from 110 all the way up to $170 a share. 55% in just a few short months. While the vast majority of the market's been getting destroyed, oil, energy has gone through the roof. And I like oil, energy going forward for 2022, but you are relying a little bit on what's going on in this conflict, right? Your gain rests in the hands of a lunatic, a psychopath. So if things get resolved there, could this revert? Sure. Now, am I saying that it will? No, I don't think so. But I want to use this as an example because I definitely can see people having that feeling, and I could definitely see oil giving back a little bit. So does it make sense at this point to buy a put in this position? So again, our example would be you bought 100 shares way back here, September, October timeframe, and you paid $11,000, and now you see that it's worth $17,000. You've had a beautiful $6,000 gain, and if you sell it, you have to pay tax on it. You've held it for less than a year, right? So if this is in a taxable account, so you could limp through the next, several months and try to find out how this thing all shakes out, or you could buy a put against your 100 shares. So let's take a look on Fidelity, but you can do this on any platform and see if it makes sense in this situation. This is how I set it up on Fidelity. In this case, we're buying to open one put contract. I gave myself an expiration date of May 20th, so about 65 days to see if this conflict resolves. And during that time, I have insurance that's going to cover me at that $160 strike price. So no matter how low Chevron goes over the next 65 days, I'm allowed to sell it, right, at $160 a share. That's all it is. So for that, it's going to cost me about $710. And probably can do it for about $700. So does it make sense for me to spend $700 to protect my $5,000 gain, the difference between what I originally paid for it, 110 and the price now, 160. It's $5,000. So I get to make sure I get to keep at least $5,000 minus the 710. That's my price. That's where you'll see that break even, 152.90. So do you want to buy this kind of insurance, right? Just like on your car. Now you could change this. You could change this 160 to 170 strike price for full term insurance, right? Just like if you had it on your car, you would say, okay, I've got for the next 65 days, if I total my car, run it into a wall, I've got coverage at full term at 170, but that would cost you more. So I picked a little bit lower price, saying give me a little bit of wiggle room. But let's think about what could happen, right? If Chevron plummets, right, goes all the way back to 110, well, I'm locking in my $5,000 gain minus my $700, right? So about 4,300 bucks. But over the next 65 days, if Chevron climbs, goes to 180, 190, well, I still get to keep the stock, but I had to pay $710 or 700 bucks, and that's gone. But I still have the stock. Maybe by then, I have a better idea of where energy is headed in the future. So that's just a basic example of when I might look to add insurance. Now I'm going to show you one that I actually have insurance on, and this one's APTS. This is a REIT, and I did a video on it a few months back. I'll link it above. It's kind of irrelevant now because this thing just took off unlike a REIT normally does. Typically, I buy REITs, I sell calls against it. I'm looking for that 10, 12, 15, 18, 20% return based on selling that call. But APTS decided to do something that REITs don't typically do, and it shot through the roof, about 67% gain on the shares that I held. Unfortunately, I limited myself because I sold calls against a lot of those shares. But the ones that did kind of go all the way through the roof, I decided I should add protection. So I'll show you that trade now and why I did that. And hopefully you bought some APTS because that's all I do is recommend the greatest stocks ever, except for Alibaba, Facebook, Citigroup, and PayPal. But other than that, I'm always right. So anyway, here's my trade with APTS. So here's a 1-year chart of APTS, Preferred Apartment Communities. And I started buying shares about the mid part of November, right around $14 a share. And I started selling the $15 calls. Then I bought some more shares as it started to climb, and I started selling the $17.50 calls. Out as far as I could, collecting dividends along the way. So everything was going hunky-dory. Now I did limit my upside, obviously, as I said, so I lost a lot of cash that way. And that's one thing to know about selling covered calls, right? You do limit your upside. But this wasn't the behavior I expected from APTS either. But yeah, it exploded all the way up there to about 25, 25 and a half. And I did not sell calls against 300 shares. And I also have some additional shares in my retirement account. So I feel like I got a pretty good position there. So I'm okay giving up some of this. But that's kind of the story. So once I got up to this $25 or so price, and I'm like, wow, there's a lot of air below me. I thought it was a good time to buy some protection. So here are my positions within APTS. You can see I had 1,300 shares altogether with an average buy price of $15.16. I sold 8 calls at that $15 call, and I collected 580 bucks. And I also sold 2 at 17 and a half, and I collected 350 bucks. So overall, as far as selling the covered calls, it wasn't a bad trade, but not nearly as good of a trade as it could have been if I had to just hold the shares. So again, a reminder, selling covered calls does limit your upside potential. Now, the third line here is the $25 put, right, for those 3 contracts, so those 300 shares that are left over. And you can see that that cost me $212. So 71 cents per share or $71 per 100 shares. So think about it. So I bought these essentially at 15 bucks and it went all the way to 25. So I've got about a $3,000 gain on just those 300 shares, right? So I've made $3,000 and I've only owned it for a few months. So for me, it makes sense to look at this because this isn't a taxable account. If I would, I want to own this for over a year and hopefully collect the dividends along the way. So the fact that it only cost me $71 per 100 shares, and each one of those, I made $1,000 on, that means it's only cost me 7%. Now I'm going to receive a couple dividends along the way too because I continue to hold this that are going to offset a lot of that $70. So it's really not costing me much to protect myself at 25 bucks a share. So again, a couple things can happen now that I've bought this insurance that goes all the way out to December 16th of 2022. One, it could go flying through the roof. It could continue on the same trajectory. In that case, well, it just cost me a little bit of insurance. So as December 16th, 2022 expiration rolls around, if this thing is worth anywhere above 26 bucks, then that's fully paid off my insurance. And anything above that, is money in my pocket. So it really didn't cost me much at all to insure this at $25 a share. Now, if it does correct back and it goes, I don't know, to 20 bucks a share, well, that's $5 times 300 shares. That's 1,500 bucks. And again, it only cost me $212 to get that coverage. So I'm well protected in this case. And it makes sense to me because I do want to own this for over 1 year. I want to have these shares and I don't want to pay 45% tax because I own this for less than a year. I'd much rather own this for the full course of the year and pay much less in tax. But right now, if I look at APTS, I'm like, wow, that seems pretty overvalued, and I don't feel great about this position anymore. But by buying that insurance, I can have confidence for the next 6, 7, 8 months until this expires that I'm in a good position. Simply from the tax perspective, this makes absolute sense, right? So if I was to sell this right now, I would be paying about 45% on that $3,000 gain, or about $1,350. But if I was to hold this for over a year, then my taxes are going to drop to about $750. So just by holding this till I've had it for over 1 year, I'm going to realize $600 in additional income. That more than covers the $212. So it's kind of a no-brainer in that sense. And just real quickly, because it just happened, was that APTS just went ex-dividend date. So those calls that I had at 15 and 17.50, they just got assigned. They got called away. Not a big deal. I think it works out well for me because a couple of those weren't out till July 15th. So the fact that they got called away now frees up my money, and it works out well for me. So that's the other side of this coin. Those calls that I sold, those are eliminated from my portfolio. No dividend for me, but I'll get that money back in play. So back to this trade, because I know I did say it's only a few button clicks and you can get this all set up. But now what happens after you're in this position as this moves along, as we move towards expiration? Well, at expiration, if it's out of the money, right, then it's going to expire worthless. So if it stays up above $25, then it's going to expire worthless. My insurance never was used, right? But if it starts falling down to 24, 23, 22 as we near expiration, well, then I have a couple choices, right? I can wait for it to finally get assigned at expiration, whatever price it's at, and get called away, knowing that I'm going to sell it for $25 no matter what price it's at. Or as I see it dropping, like if it drops significantly and it's relatively quick, or we're near expiration and I see this current value going up and up and up, then I can sell to close it out and I can collect the current value. As long as it's more than my cost basis over here, I will make money on this trade. It just depends on how I want to handle it internally. So if you have questions on any of that, I'm happy to answer questions. We never really know when Melvin Moody and his big teeth are going to show up, but we can protect ourselves as long as we understand the mechanics of a protective put. So it's one of those things we want to have in our back pocket, in our utility belt, that we can deploy whenever we need to. We can pull it out and buy that protective put. So for example, your stock flies through the roof like we showed. You want to protect that gain? Maybe it's time for a protective put. Maybe you're wise enough because you saw 2021 and you just have a very simple 3-fund portfolio. You're like, wow, VTI did really good in 2021. So first quarter of 2022, I'll buy myself some protection because I see all these crazy things going on in the world. You'd be a very wise man. Unfortunately, too late to do it now. But if you were able to sniff it out, you would have saved yourself lots of money with a protective put. So look for those opportunities. Now, if you have any questions on any of this, please ask down below. I really appreciate you watching. If you like this kind of content, please like and subscribe. See you next time. Take care. Have a great night. Whoop.